GIPS presentation and reporting and the valuation hierarchy. The Global Investment Performance Standards, GIPS, place significant emphasis on presentation and reporting because accurate performance calculations alone are insufficient if results are not communicated fairly and consistently. GIPS reporting is designed to provide prospective clients and investors with transparent, comparable, and reliable information regarding an investment strategy's historical performance. Firms claiming compliance must make every reasonable effort to provide a GIPS report when marketing a strategy to prospective clients or investors. The purpose of the report is to enable informed decision-making by presenting standardized performance information alongside required disclosures. Consistent reporting practices strengthen investor confidence and support fair competition among investment management firms globally. A central requirement of GIPS reporting is the presentation of historical performance data. Upon adopting GIPS, firms must present at least 5 years of compliant annual performance history, unless the composite has existed for a shorter period. Thereafter, firms must continue extending the record annually until a 10-year compliant history is established. This requirement helps prospective clients evaluate performance across different market environments and economic cycles. Long-term performance records provide a more meaningful assessment of investment skill than short-term results, which may be influenced by temporary market conditions. By emphasizing extended performance histories, GIPS encourages investors to focus on consistency and sustainability rather than isolated periods of strong returns. GIPS reports must include several key performance and size measures that provide context for evaluating investment results. Required disclosures include time-weighted returns for both the composite and the benchmark, total firm assets, and total composite assets. If a composite contains 6 or more portfolios, the number of portfolios must also be disclosed. These measures allow prospective clients to assess both performance outcomes and the scale of the investment strategy. Benchmark comparisons are particularly important because they provide a reference point for evaluating relative performance. Comprehensive reporting of returns and asset information improves transparency and facilitates meaningful comparisons among competing investment managers. Risk disclosure is another important component of GIPS reporting. Investors require information not only about returns but also about the risks associated with achieving those returns. GIPS therefore requires annual measures of internal composite dispersion, benchmark dispersion, and overall composite dispersion. Internal dispersion evaluates the consistency of returns among portfolios within the composite. Large internal dispersion may indicate inconsistent implementation of the investment strategy or an overly broad composite definition. Benchmark and composite dispersion measures provide broader perspectives on historical risk characteristics. These disclosures help investors assess return variability and determine whether portfolio outcomes have been achieved in a manner consistent with the stated investment mandate. GIPS also addresses the portability of performance records when firms merge, acquire other businesses, or hire investment teams from external organizations. Historical performance may be linked to a new firm if substantially all decision-makers are retained, the investment process remains substantially intact, adequate records are maintained, and no break exists in the performance record. These requirements ensure that reported historical performance remains representative of the individuals and processes responsible for generating prior results. Portability rules prevent firms from claiming performance histories that are not genuinely connected to their current investment capabilities. Consequently, investors can place greater confidence in the continuity and relevance of reported performance information. Accurate reporting depends heavily on reliable asset valuation, which is why the valuation hierarchy is an important component of the GIPS framework. GIPS defines fair value as the amount at which an asset could be exchanged in an arm's-length transaction between knowledgeable and willing parties. Fair value should include accrued income for bonds and other income-generating assets. Firms are required to document valuation methodologies and processes and apply them consistently within composites or pooled funds. Reliable valuation practices are essential because performance calculations, risk measures, and composite reporting all depend on accurate asset values. Without consistent valuation standards, performance reporting could become misleading or incomparable. The GIPS valuation hierarchy establishes a recommended order for determining fair value when multiple valuation methods are available. The highest priority method is the quoted price of an identical asset in a liquid market on the same day. If such information is unavailable, firms may use the quoted price of a similar asset in a liquid market. The next level involves prices for identical or similar assets in inactive markets where trading activity is limited. If market prices remain unavailable, firms may rely on valuation models based on observable market inputs. Each lower level is used only when higher-level information cannot reasonably be obtained, ensuring that valuations remain as objective as possible. The integration of GIPS presentation requirements and the valuation hierarchy promotes transparency, comparability, and integrity throughout investment performance reporting. Presentation and reporting standards ensure that investors receive meaningful information regarding performance, risk, asset size, and benchmark comparisons. The valuation hierarchy supports these objectives by providing a disciplined framework for determining fair value and maintaining consistency in performance calculations. Together, these requirements enhance investor confidence and strengthen the credibility of performance presentations. For CFA candidates, understanding GIPS reporting standards and valuation principles is essential because they form the foundation of ethical performance communication, manager evaluation, and compliance with globally recognized investment performance standards.